Hello, everybody. My name is Paul Archowski, and I am here today with Michael Moskal, our Director of Investments, and Scott Lipa, our Senior Research Analyst. And we're here today to share some of our insights with you on what's going on with the economy and the markets, and just share some of our insights. So with that, I'm going to turn it over to Michael to lead us off here.
Well, thank you, Paul, and hello again, everybody. And well, it's been quite a past year, from the shock of COVID to the unprecedented money printing and stimulus from the US government and the Fed to the now tug of war going on between the marketplace and the Fed on interest rates. We certainly do live in fascinating times here. So, with that, let's go ahead and get started with our review. First thing I thought we'd look at is go back to, we did a recording in January. I thought we'd go back and look at that and what we expected that was going to happen this year with our outlook and predictions. And so far, Paul and Scott, we've been right on with what we said. So in January, we said we expected the tsunami of trillions of dollars to continue from the central banks and federal government. This was all the money printing that went on last year. We expected that to continue this year. Modern monetary theory, MMT, embraced worldwide. And just quickly, MMT, modern monetary theory, is just an economic theory that says you can print almost unlimited amounts of money in your own currency and go spend it out into the economy. That would be the government doing that. And, unless you had higher inflation and as long as the Fed would keep rates down low. So that's been embraced worldwide. It's not just the US, but there's many other countries around the world that are printing money like crazy. So that's continued this year. We've had a number of things happen from the US government. We had COVID Relief 2 that was signed into law in January. That was about $1 trillion. And we recently had, of course, the American Rescue Plan that was in March. That was 1.9 trillion. I thought it's interesting. I'm not sure the government's trying to get into the same sales technique that other retailers do when they say something's like $1.99, to make it sound like it's more like $1 instead of $2. The government passing these, it's 900 billion, not $1 trillion. It's 1.9 trillion, not 2 trillion. So, of course, infrastructure. President Biden has proposed over $2 trillion of infrastructure. We'll see if that happens. It seems to have some steam though going with it. So something's probably going to happen this year in regards to that. May not be 2 trillion, but it will be something certainly probably north of $1 trillion. And then the Fed continues to print money also. They're printing about $120 billion a month, which is $1.4 trillion on an annual basis. And they're buying mortgage and treasury bonds. And again, why are they doing all this? Because they're trying to make the economy and the markets look better. If you're a politician or you're in office, you want to try and make things look better. And this is the way that they're able to do it right now, is by printing lots of money. That's the positive. The positive is it makes things look better. Of course, the negative is it's not free. At least we don't think it's free. And someone's going to be paying for this down the road in some way, shape, or form. And maybe we're already seeing it, in the marketplace with inflation.
So, Michael, when I look at this slide, what I see is, or what sticks out to me, is a lot of money in motion, and it's sort of like anything in life. And anytime you have a problem in life, it's always easy to throw money at the problem to fix it. That's usually people's first solution with anything, and that's what I see here: a lot of money in motion. So, when I'm talking to clients, a lot of the conversations I'm having right now are, the market's had an amazing run since last March. Is the market overvalued? How can the market keep going up? And my thought on it is this: the economy with a lot of money in motion, and in my mind, all this money has to find its way to the stock market over the next couple of years, because we haven't touched on it yet, but with interest rates at zero, where else will this money find its way to besides the market? So while we can look at the market and say maybe it's overvalued, maybe it's undervalued, that's another debate we can have. What I see is a lot of money in motion that will find its way to the market over the next few years.
Yeah, that's good. Really good point, Scott. And actually, one of our topics we're talking about today is whether the market's overvalued or undervalued a little bit later here. But yeah, so the difference, by the way, because I've gotten questions also from some people say, well, haven't we been doing a lot of this the last 10 years and printing money, and the Fed's been printing money, and why haven't we seen inflation going up or things going on? There's a difference here. The Fed's money, when they print it, they're not able to, of course, put it into the economy directly. what they're doing with the money is they're buying mortgage and treasury bonds in the effort to push rates down lower, interest rates down lower, which they have been successful at doing. And when that happens, you're absolutely right. It drives people into higher risk assets, which Ben Bernanke, who is the Fed chairman back when the crisis happened in 2009, he said he wanted to do that. I want people to buy risk assets. Risk assets meaning really stocks. So you're absolutely right. As long as the Fed continues to do this, it does have this upward push on equity prices. Now, the government printing money, they're actually able to do something different, of course, and they can actually put it directly into the economy, just like when they send checks out to people, which they have been doing. And some of that money that people get will find its way into the stock market. A lot of it's going to find its way into the economy. We all know people and have friends and gotten checks, and that's where money is going. People are certainly, with all the pent up demand with COVID, with the COVID relief coming, they want to spend money on things and go out and do things and take trips and all that kind of stuff. So, the intention is that is the intention. What you're saying, it is to try and push stock prices up, and it is try to get the economy going hotter.
Yeah. Quick story on that. I know I have a client that owns a couple of car lots, car dealerships, and I talked to him a couple of weeks ago, and this is the time of year he makes hay because people come with their tax refund checks and use that as down payment on the car. And he's telling me that he just went out to his lot when that second stimulus was passed. He just went out to his lot and marked up every car $2,800 because he knew people were going to show up with two checks this year, a tax refund check and a stimulus check. So while the end user or the person getting the check may not invest that money in the market, this guy who owns a car dealership, and a lot of business owners are going to do that. That's where you see the inflation, and that money, I think, is how stimulus finds its way to the stock market.
Yeah, and it's funny with the car situation because, of course, we have a really strange situation that used car prices have skyrocketed. And it's almost less expensive to buy a new car than it is a used car for some makes and models. And I have a Ford Expedition, and the Expedition, I can get more for that vehicle, now than I could try to buy if I try to buy a newer used vehicle or something.
Crazy.
So it is kind of crazy what's going on. Second thing we talked about in January was infrastructure spending. We kind of anticipated that was something that Biden had talked about doing, President Biden, and that was going to favor value stocks. And value stocks are stocks that are considered to be cheaper in the marketplace, less expensive. Growth stocks are primarily in the technology sector. We've seen value stocks this year really skyrocket versus growth, unlike last year. So, energy's up 38%, financials, which are, banks and other institutions, up 25%, materials and industrials. Materials, we have the graph right here. What are materials? Bricks, cement, concrete, glass, wood. And, Scott, you had talked about, one of our clients, it's a lumber company or a builder, and what they're having problems as far as lumber prices going up. We have nursery clients that deal a lot in resin. Resin prices have tripled over the last year. So we're definitely seeing prices and materials go up a lot, which is pushing those stock prices up. Industrials, Dow Jones Industrial Average is industrial stocks. So, stocks like Caterpillar, which makes heavy machinery, Corning, which makes glass, which is used in iPhones. They produce a lot of glass for iPhones. But those are all the top performing sectors in 2021. So that so far has been right. And I think we do continue to think that's going to be right. You guys agree with that?
Michael, I think that makes perfect sense to me because if you go back to last March and you think about while we're all sitting home from last March through most of summer, the only stocks that really did well in 2020 were related to shelter in place or stay home, right? The Amazons of the world, the Zooms of the world did extremely well, but everybody overlooked every other sector and just piled into to the technology sector or the shelter in place trade all the way through maybe last November. So for 2021, you would think, as we talked about last slide, with all this money finding its way to the market over the next few years, when I'm looking to put money to work for clients and I'm looking at technology and seeing what happened last year, I'm looking for value or things that haven't been bid up as a result of the shelter in place trade. And it's all the sectors you're mentioning right now. So I would anticipate this would continue at least through 2021 and maybe beyond.
Yeah, and a lot has to do with, of course, with the economy opening up, and it's understandable last year that with the economy shutting down, that you had a lot of the sectors we're talking about right now, the companies weren't doing things. People were at home, They weren't making things. No one's buying anything. So absolutely, 100% what you said. Third thing we talked about in January was government spending and borrowing was likely to push inflation higher. And this kind of goes back to what I did mention before about why didn't we see high inflation last decade when there was a lot of borrowing, when there was a lot of printing of money going on. And again, it was really the Fed printing it and buying asset prices. We did see inflation in the asset price area last decade with stock and bond prices going up. But now we're seeing it into the general economy. Last month in April, we saw that just for the month of April, 0.8% increase in inflation, which translates into a 9.6% annualized rate, which is crazy. To think of that, because we've been printing inflation rates, less than 2% for the last decade or so. So we see inflation spiking like this, something is definitely happening despite, and I've sent emails out to clients where I say, despite the denials and protestations of the Fed, who says, no, no, we don't have a lot of inflation. We got inflation. Anybody that goes to the grocery store, goes to buy a car or goes to buy, whatever they're buying, in the marketplace, prices are definitely up, and maybe for some things they're down, but for most things I know in our household, we look at our budget and prices are up with a lot of things that we're buying for our kids.
One of the big
So,
discussions right now, though, is whether this inflation is transitory or not, and is it a temporary? Are we just catching up for stuff?
Transitory inflation is a term I had never heard of till about 6 months ago. I feel like it's a
Right.
completely made up term and I get the idea that maybe it's pent up demand and that's what's creating the inflation. But in my mind, I look at like when I was a kid, gas prices were 89 cents. Gas prices will never be 89 cents again. So maybe part of this inflation is transitory, but like a 2x4 that was $1.50 or $2 a year ago will never be $2 again. It's not going to be the $8 it is today. Maybe it goes back to somewhere between 3, 4, $5. But yeah, some of the inflation may be transitory, but it's not all transitory. We're not going back to the original prices pre-COVID anytime soon, or probably not ever. So the inflation conversation kind of drives me crazy because some of this is real inflation and it is here to stay.
yeah, and I think you're both right, by the way, because I think it's there is to me we're not going to have 10% inflation now going out into the future. So there is a portion of this, a segment of this that is transitory, just because you have all this pent up demand of people going out and doing things, and all of a sudden companies are buying product again. My brother-in-law is an excavator, and he said for the first time that he can ever remember in business, and it's actually legal because he signs contracts with the suppliers, but he says they've never exercised a clause in there where they can just renege on supplies that they sell them. And he said for the first time in his career, they're doing it because they say, heck, I can't sell this. And when they sign a contract, he says, I'm going to buy this product from you 6 months from now at X dollars. And now they're saying, I can't sell it to you for X dollars. It's going to have to be X times two. So they're reneging on their contracts. And so some of that stuff's going to go away. Some of it won't go away. I would say this. We also have clients that have had increased prices on their products because their supplies are going up. So some of our construction clients, if they're paying more for costs right now, not all that's going to be rolled back. If they have to pass on a 5% increase in prices of the products to the customer, they may not be rolling all that back if things go, when prices maybe in supplies go back to a little bit to the way they were. So some of this is not going to be rolled back. There's also a mindset that happens with inflation. And this is why, for those of us who've been around long enough, this is why they wanted to wring inflation out when we did back in the early 80s, in the economy, because there's a certain mindset that goes on with consumers, people that are buying things. If they think prices are going to go up, what are they going to do? They're going to buy more of it today. And the more they buy, that's called demand for the supply, it pushes prices up even more. So there's a sort of inflation mindset that goes with this. And that's why it's kind of crazy, Scott, when you talk about the inflation and how it's kind of this crazy discussion going on, that the Fed, they want inflation higher. We want inflation higher. It's like, well, that's kind of a dangerous thing to want to go higher like that. So I don't think we're going to see, inflation go back to being where it was before, in the low, it's 0 to 1%. So, but it's certainly not 10%. So that's something that probably is transitory. All right. Well, how are we looking in the investment markets so far this year? Things have actually been very good. We've been a little stagnant, I'd say, the last 3 weeks or so. But year to date, everything's positive as far as the general indexes are concerned. The MSCI is a all country index in the stock market that looks at world stock markets. It's up 8%. We're doing a little bit better in this country. The Dow's up 12, S&P 11. We've seen a total reversal, as we've been talking about. We've seen a total reversal in the value versus growth story. Last year value was barely up, was flat for the year, while growth was up 37% last year in 2020. Now we've seen just the opposite happen, where value now is taken over, up 17%, 17.1. Growth is up 4.2. And again, the difference in the stocks, growth is made up primarily of technology stocks. Bonds are down for the year, and that's a function of interest rates have gone up, not short-term rates. Anybody who has money at the bank knows that they're still not making anything on their savings, money market, or CDs. But medium to longer term rates, the 10-year Treasury rate, U.S. Treasury bond rate, has gone from 90.91, a little bit under 1%, to 1.6%. Since the beginning of the year, which again, there's an inverse relationship. As rates go up, bond prices go down, which pushes bond values down. Higher rates, by the way, of course, are good for people who are buying now. They could buy a 10-year bond at 1.6% versus 0.91 at the beginning of the year. But anybody who owns bonds, as rates do go up, it does push prices down a bit. Oil is just the opposite story as it was last year. We touched on that already with all the pent-up demand going on. Oil is up almost 35% a barrel of oil this year. It was down 23%. You guys remember when oil hit negative per barrel last summer? By the way, those are always I shouldn't say always, but those are indicators oftentimes when you see prices down, like oil was actually negative at one point, price of a barrel of oil. Probably not going to get much lower than that. Those are usually the good times to buy if you have patience to wait. Gold, opposite, I don't have on here that it was up, but it was up 22% last year. It's down a little bit. Interestingly enough, though, gold stocks are up 10% for the year. So gold stocks are doing better than the actual gold as far as an ounce of gold is concerned. And if you look at the average investor who may have a 60-40 mix, younger people obviously would be a little more aggressive usually, and older people a little less aggressive, but sort of the average investor over all ages oftentimes is looked at as sort of a 60-40 investor, 60% being in stocks or equities, 40% fixed income. A typical investor is up about 5.5% when you blend in bonds and stocks this year. So, which is not bad. You're talking about May, so you're talking about 10%, greater than 10% return, 12% return for the year if this continues. So a good start to the year. All right, let's get into our hotly debated topics here, which we mentioned before about interest rates. There's a lot of discussion going on. Consensus view, and I have a quote from economist Gary Schilling here, and the consensus view is that the economy is going to open rapidly, and which it seems to be. Inflation is going to come roaring back, which it kind of is, and interest rates are going through the roof, which they have not yet. So in his view, again, this is his quote, this is way overdone. He still believes we're in a low inflation, if not deflationary era. So there's two ways to look at this. Some believe that we are going to have this skyrocketing interest rates, and some believe that we're not going to have it. And of course, implications to the two clients' investments are very important here, because higher interest rates mean one thing, lower rates mean another thing. So with lower rates, of course, it's good for stocks, because as we just discussed, the lower interest rates are, the more it pushes people into wanting to get higher rates of return, which are typically going to be into what are called risk assets, which would be primarily stocks. Rates going up makes investments at the bank, CDs, money markets look better. If you can make 5% on a CD at the bank, you may be less inclined to go buy stocks or take extra risk. So there are implications there. What do you guys think? Rates up or down?
No, I I don't know what did Jay Powell say. They're not even thinking about raising interest rates, and the Fed has already given guidance that they're not going to raise rates till 2023. I don't even think that's possible given the inflation we're seeing. What I've been talking to clients, what I've been saying is I anticipate or would expect the Fed to start raising rates at some point in 2022, maybe this time next year, if the market's still running hot. But realistically, it's going to be years. I mean, they're going to have to do it extremely slowly. It's going to be extremely calculated, and it's going to be years and years, 3, 4, 5 years before we see interest rates normalize in that 4, 5, 6% range.
Yeah, I agree completely. They're going to take as long as they can, in raising these rates, and they're going to trend up, but they're going to trend up very, very, very slow.
Yeah, I don't see how they can't. The minute they start raising rates, the market's going to have a taper a tantrum. You're going to see the market pull back. It's going to have to be very slow, very telegraphed. I don't know. I just think it's going to take a very long time. I just don't think they can wait till 2023, though.
Yeah, and this was something that we've discussed in investment committee meetings, which we have on Monday mornings. But to me, the Fed's in a box. Fed's in a box. Jay Powell tried to do the right thing back in 2018, and he did for a little bit. He raised rates. He was trying to raise short-term rates off of zero because Ben Bernanke and Janet Yellen, who was she's Treasury Secretary now, but she was the Fed chair, back in the mid last decade. They kept rates at zero, for a long, long time, for many years, for 7 years, 8 years. So Jay Powell tried in 2018 to start normalizing rates, and they tried to telegraph it. Remember this? He tried to telegraph and say, "Look, we're going to raise rates. We're going to cut back on the spending of monthly money on buying bonds," and they did. And the stock market threw a tantrum. The stock market threw a temper tantrum, and the stock market started going down. The then president Donald Trump, he was famous for tweeting things out, but he tweeted how bad Jay Powell was. The guy's horrible. I'm going to fire him. All those kind of things, which I get, by the way, because no president wants to have rates go higher and hurt the economy. They'd rather have rates lower and keep things going. But Powell did what we call the Powell pivot. You guys remember that? And within 30 days, he went from saying we definitely are going to be raising rates for the next year to we're going to cut rates. So a lot of pressure on Jay Powell to not raise rates. So I agree with you. I agree. They're going to wait as long as they can. Jay Powell may be crossing his fingers and hoping he's out of office by that point in time. He's not the Fed chairman anymore by the time they have to do that. But they're in a box because he knows if they start raising rates, no matter how they telegraph it, raising rates is going to have an impact on the stock market that's probably not going to be positive, and he's going to get blamed for it. And so, but yet, here's the other thing. The other thing that's incentivized for the government, the government does not want rates higher. With all this printing of money and all the debt, we're at what, $30 trillion now of debt. The interest costs on the debt, even though it's low, it's still interest costs, it's still got to be paid back. So the more that the government gets into debt, the more interest costs there is on that debt. And the government, if they have the choice, of course, do you want it to be low, pay it at lower rates or higher rates? Lower rates. So for them, they would prefer to have lower rates and higher inflation, because they would rather inflate the debt away over time. So if they borrow $1 today, if they can get inflation going hotter, maybe it only cost 80 cents 5 years from now to pay that dollar back. So the incentive is not to raise rates for sure. So I don't think, I would say until it becomes politically untenable, until there's a lot of pressure bearing down on the Fed politically to raise rates, that they're going to make all kinds of excuses why they just can't raise them. Which
So,
they have.
Michael, one thing you mentioned about borrowing money right now and leaving rates at zero. One unintended consequence, I think, of this whole thing has been, and I see it in my neighborhood, I'm sure you see it in your neighborhood, the housing market itself. People are borrowing more money and paying more for homes, and homes are selling within days, and people are getting asking price or above asking price. So one unintended consequence of these interest rates at zero is I think it's creating another housing bubble. And I'm curious as to how this housing bubble ends, because it's not the same as the housing crisis we had back in 08, 09, because people are borrowing money, but they're borrowing at such a low rate. So I wonder where that ends. You don't hear a lot about it, but the inventory of houses is low and people are borrowing more, but they're borrowing it next to nothing. So I wonder how that affects housing prices over the next 5 to 10 years.
Well, debt is debt. And it's interesting because the debate has been shaped that it's so cheap you got to borrow money. And I'm not talking about housing because there's a lot of
Anything,
people who want.
anything you buy right now, you borrow money. I'd rather use someone else's money than my own. That's when interest rates are this low. That's just common sense.
True, but you still have the debt. So if I go
Yeah.
to my bank today and I borrow $100,000, and I go buy a car and buy all kind of stuff and stick it in my driveway, my neighbors are going to sit there and say, "Wow, look at this guy." But I still owe it. Even if I borrowed it at 2% or 1% or 3%, I still owe the money and I still owe the money back. So I'm borrowing. I'm not saying it's bad, by the way. I'm just saying there's been sort of this feeling that it's just like you just do it because it's not, you do it for free. It's like, well, it's not for free. You still owe the money. If I did that, I still owe the bank $100,000, which has got to come out of something, which is going to come out of my future pay. It's going to come out of the future somewhere. So debt is just always borrowing from the future. I'm not saying it's bad because oftentimes it can be good. If a business borrows money to build a new plant, hire more people, increase their business, okay, that's a chance they're taking, but it's still debt they got to pay back. So I get it that rates are low, and I get it it's cheap to borrow, but it doesn't mean that doesn't mean it's not debt that's got to be paid back at some point in time. So uh, now that doesn't directly address the housing. I would say, like any bubble, if you want to call it a bubble, or any irrational, exuberant price increase that happens with any asset, of course you're going to have a decrease happen in the future. Housing prices were up 12% last year on average. They're not going to keep going up 12%. We're going to have a deflationary housing price environment at some point because it evens out. Housing prices should not be going up at 12% on average over time. They don't do that. So it doesn't mean a crash, and it doesn't mean that we're going to have a housing debacle like we had back in the mid 2000s. It just means that, of course, this can't continue that way. But we do have debt still on the books. So, to me, it's not quite the no brainer. Let's borrow money like crazy. People may do it. And, housing is a little different to me because it's a house. You live there. My family's in this house. I got 4 kids. So we live in houses because it's our home. So but yeah, it can't continue that way. Does debt matter anymore, Scott?
Not when money's free.
Our next topic. Well, Stephanie Kelton would agree with you. So this goes back to the MMT debate. Okay, modern monetary theory. I actually had a picture. I would go back to it real quickly. I didn't mention it, but we call it, sometimes it's called the magic money tree. MMT, magic money tree, MMT, magic money tree. Where money just comes down off a tree for free. So she wrote a book called The Deficit Myth, and I was on a webcast actually when she was on a webcast, and I got on the webcast. Where she was espousing, and this is being taught in colleges for right or wrong. She's a professor at Stony Brook University, and there's a class in it. She's teaching her economics class. They're teaching it. That the debt doesn't really pose any kind of financial burden. That as long as, again, you can print money in your own currency, which we do in the dollar, and as long as the central bank will keep rates low, and as long as inflation doesn't get out of control, which I don't know what that means. There's no definition of what the rate would be out of control, but that you can just print almost unlimited sums of money in your own currency and spend it into the economy. So when I wrote in a question to her and I said, isn't there some kind of limit though at some point? I mean, 100 trillion? Isn't there something where you say, okay, we just can't do this anymore of debt? And she addressed the question on the webcast and said, we need to get away from calling this debt. It's not debt, it's investment. So we need to get away from calling it debt, government debt, it's investment. Because the government, it prints money and it spends it, invests it into the economy. It's an investment, not debt. So I scratched my head and said, okay, I don't get it, but because we still owe it. I mean, again, if I go borrow money from whatever source, I still, whether I invest that money or not, it's still a debt I owe. But that's the theory. The theory is that we can just keep this chart here going up and up and up, and this really doesn't do anything. And I just have a really hard time believing that, because Paul and Scott, I'll pull my list out here. Going back 1,000 years, I got 13 pages of societies over the past 1,000 years who have tried this. Where they print money. Going back to the ancient Romans, the Romans used to get a coin. They had silver and gold coins, and they would just shave the edge of the coin off, and make a new coin out of it. That's how they printed money, and it didn't work. It made inflation high in their country, in their society, and it pushed the value of their currency down, and it wrecked their society over time. And I'm not saying our society and our economy is going to go down the tube right now, but if you keep doing this and devaluing your currency, it's not good. And you can look back just the last century. Germany tried to do it after World War I. I mean, you can go on and on and on. It never ends up good. It
Yeah,
never ends up
I
good.
think my takeaway from this slide is my kids aren't going to Stony Brook University. That's all I got on that. It makes no sense.
Yeah, it just doesn't make sense, but it is taking hold. And again, for right or wrong, the government and politicians in the government are espousing this. They're espousing this, and they're saying things like, our leading economists say that we can just go ahead and deficit spend, and it'll be better for the long term. I don't get it. So from an investment standpoint, again, it helps the markets right now when they're printing all this money. We got to be really careful with clients down the road and being invested in the right things and not over risk up, because at some point in time, we're all going to pay for this. All right, stocks under or overvalued. Big debate that goes on right now in the investment financial industry, our industry right now. Some people say it's not. Brian Westbury, he's a chief economist at First Trust. Stocks are cheap. As long as the Fed keeps highly accommodative, that's just another term for printing money. As long as the Fed keeps printing money, there's trillions of dollars of cash out there. The economy is expanding. The market's undervalued. Warren Buffett years ago said this indicator was one that he looked at to tell him whether, the stock market was overvalued or undervalued. And this goes back to 1950. 100%, by the way, is about the average. 100% on this chart, if you average it out, something like that, somewhere in that range. We're at 200%. So Buffett's own indicator would say that stocks are really kind of incredibly overvalued. That doesn't mean, by the way, we've been there for 10 years. So it doesn't mean, and the stock market's gone up a lot in the last 10 years. So it doesn't mean that this is a sell signal. But again, from our perspective of managing money, we always have this in the back of our head to say, gosh, I mean, and this isn't one of many charts, right, guys? We've looked at a lot of charts in our investment committee meetings.
Well, I think, Michael, when you showed me this slide, I said, I'm shocked you found a guy that was saying stocks are cheap.
Yeah.
I didn't know you could find an account. I guess anybody will say anything for a soundbite. My thought on this, though, is in the 25 years I've been doing this, what I've learned is stocks can be overvalued or undervalued, but they can remain that way for a lot longer than you and I think they should, or than they probably should. So I would say stocks are overvalued, but that does not mean that they can't remain overvalued for years and years. And go back to your original slide of all that money being pushed out into the economy, all that money in motion, finding its way to the market tells me that even though the market looks overvalued from this chart, it doesn't mean it can't stay that way a lot longer than we think it should.
Yeah, and there's that. What you're saying, Scott, is supported by, Barron's does the money poll twice a year. It's published in Money Poll. And they go out and survey, I think it's 167 advisors, of which we're one. So I filled the survey out and I sent it back. And fascinating, in this past survey that they did, which was published in Barron's just this past, I think it was 3 weeks ago, that it was, I believe it was 65% of advisors believe the market is overvalued, but 75% of them are bullish on stocks. So everybody's sitting there saying, yeah, we know the market's overvalued, but you still got to buy stocks. So it's just one of those things where everybody's sort of in the same boat, but you got to be really careful, because at some point something happens. We've been around long enough. All of us here on this call have been around long enough in the marketplace to know when stocks get overvalued like this, at some point something happens, maybe in something we can't even see right now, like COVID happened last year. Something happens to end up rectifying that situation and making stocks more fairly valued. At some point something will happen. So for our older clients, clients who have a shorter time horizon, we just got to be careful, not be over risked. It's a tough situation right now because low risk investments don't pay a lot. But, it's one of those situations like my parents. Here's my parents, 85 years old, and they're, living off their savings all these years, which is great. They saved up money over all those years. and it's a tough balancing act managing their portfolio because I'd prefer to have them at the bank making 6% in CDs, with their money. That would be fine with me, but I can't, so I got to have them invested in probably a little bit more equities than I would prefer, but it's one of those situations you got to do it if you're going to try to make any money. So, but you got to keep a real close eye. So, yeah, I guess the bottom line of this is stocks by measurements that we look at are overvalued, but you still got to be invested, in the stock market. This is really a summary of everything we talked about in this call. We're overweight value stocks and what we're doing for clients, all the industries we talked about. One thing we didn't really talk about a lot here is international, which I suspect probably we're going to be talking about more in the future. International stocks have not performed very well relative to U.S. stocks the last decade. We may see a shift happening. China is going to probably overtake us as the world's biggest economy in this decade, the way they're growing, which is not a bad thing. Doesn't mean the U.S. is going down the tubes. At one time, Great Britain was the world's largest economy. We overtook them, and they didn't go away. But with China's growth rate, Asia, Southeast Asia is probably the place you're going to see the most growth. So we are looking at increasing stock exposure, stock positions in those areas. Inflation oriented, we talked about. Paul, we didn't talk about Bitcoin much. Bitcoin was very much in the news about 3 weeks ago. And then you had a 40,
but not for the right reasons necessarily. So
yeah, you had a 40% drop in Bitcoin. Also, no one wants to really buy it anymore right now. But we do very much believe in blockchain. Blockchain is the engine that drives Bitcoin and the cryptocurrencies, as well as a lot of the pay systems that are electronic, like Square. It's all blockchain related. So we do believe very much in blockchain related technology, electronic technology, the electronic guts that's behind a lot of this crypto. And so we are invested in some of those too, by the way. So the Squares of the world, the PayPals of the world, those are all blockchain related companies. There's actually an ETF that we invest some of our portfolios in the stocks that are in the ETF called Block, BLOK, which is blockchain. So we are I think we're very much a believer in blockchain for the long term.
Michael, how long do you think it takes for us to adopt a cryptocurrency? Like, I get the idea behind it. I get the concept of what we're doing right now. Like the U.S., the way we're printing money right now, we can manipulate the value of a dollar. Any central bank can manipulate the value of their dollar. So a cryptocurrency, I guess theoretically can't be manipulated by a sovereign, by a country. So the concept makes perfect sense. But I feel like for it to be adopted as a currency that we're all using, it would have to be backed, or one of these cryptocurrencies going to find a way to have to be backed by something. I don't know if it's a government or a central bank or some sort of entity that backs it. Otherwise, I don't see mainstream adoption of a cryptocurrency.
Well, look at it this way. I asked myself a question. It says, what are the odds that the U.S. government and the Federal Reserve would allow a unrelated cryptocurrency, okay, so something that's not controlled by the federal government, like Bitcoin, to become a dominant currency used in the country? And I sit there and say, maybe I can't give it 100%, but boy, I got to be pretty close. Probably. I can't imagine the government. And there's governments around the world that have done it. China did it already. I can't remember which country, Paul, in Europe. Was it Netherlands, or they already outlawed it? That people can't transact in Bitcoin. But more countries are doing that because the governments are sitting there saying, we're not letting control of our currency go somewhere we don't know. So exactly, Scott. It's going to have to be, the government, the Fed is already talking about it now because Jay Powell, in his last press conference, said he had that question asked because Bitcoin at that time was going hot, and he was asked about it, and he said, we're looking into it. It's one of the things we're looking into as far as having some kind of Fed coin, some kind of cryptocurrency that's run by the government. So, but yeah, I think that's going to happen down the road. We're not going to use paper money at some point in this country, or we're not going to use, again, coinage. We're going to be doing everything electronic. People already do Venmo every day.
I don't think people use paper money now. I can't remember the last time. I never have paper money on me. I'd be a horrible person to rob. It's like they I don't know. Everything's either
I'm glad
done
you
like
said that in the video.
Venmo, PayPal, like, yeah, don't bother with me. I don't have a dollar in my wallet. I can't remember last time I needed paper currency for anything. Everybody accepts either a Venmo or PayPal or credit card or whatever the case may be. So it just makes sense to go to like a Fed coin makes a lot more sense to me than all these cryptocurrencies right now. I think to me, it's like betting on a horse race. Whether or not any of them actually survive and actually are the prevailing cryptocurrency, that's anyone's guess, I think.
Well, I think right now it's happening. It's in a very nascent stage. Crypto. So it's only been around. It's not been around that long period, but it's only been around in the marketplace, for just a few years. But there's like a sort of question going on right now. What is this thing? Is it a currency, a potential currency, or is it just a speculative investment tool, which it could be? So I don't see it right now, even though companies and there's places that are accepting Bitcoin, which I thought was, by the way, funny that Elon Musk, he was accepting Bitcoin for Tesla vehicles as long as it was going up. And when it started going down, he came out and said, no, we're not accepting Bitcoin anymore for Teslas. As they get the Bitcoin in, all of a sudden tomorrow it's worth 10% less in dollar terms. So it's not a currency. You can't really use it as a currency. It's not stable enough. It fluctuates so much. The US dollar, the dollar that I do have a dollar in my wallet. The dollar I have in my wallet doesn't fluctuate on a day-to-day basis much. Again, we talked about inflation, but you're not talking about 10 or 20% a day. So the dollar I have in my wallet, I go out there and spend it. I'm pretty confident tomorrow I can buy a dollar's worth of things still, or something very close to it. So Bitcoin, who knows, or any of the cryptos, Paul.
Right.
So it's just not, to me right now. If you're putting money into, whether it's the cryptos, or whether it's the trusts that own the cryptos, like the grayscales, you know, that's just a speculative investment, which may be fine for portfolios. Again, it may be okay, to have a little bit of a portfolio in some speculative investments, like a Bitcoin, or like other kind of speculative commodities. So, but definitely not right now, at least not for currency. Anything on bonds, guys? Bonds, shorter duration. There's ways we're trying to get yields up, which we have. Our currency complement portfolio, which has been a huge, part of a lot of people's portfolios. Clients every day are calling, right? That have money in cash that say, I can't stand looking at my bank statement anymore. I'm getting $4.12 a year in their interest. I can't take it. We do have the currency complement portfolio, which is, yields over 3%, pretty low risk. But again, bonds can still offer safety here. It's not like we want to get rid of bonds, because bonds still offer safety during times when the stock market's not doing well.
Right. I like the idea of bond ladders as well. Right now, as 2021 rung of the ladder matures, I have conversations with clients. What do we want to do with this bucket of cash? The Fed hasn't started raising rates yet. The market looks pretty good. Do we want to move more toward market-like investments, or if the Fed starts raising rates next year, like I think they will, as 2022 bonds come available, do we want to go out to 2025, 2026 based on where interest rates are at that time? So I think laddering bonds gives you a lot of flexibility as far as, like you're saying, Michael, you need that conservative piece of the portfolio, even though at times it's difficult to stomach the fact that bond yields are so low. I think that's a temporary thing that you're going to see change over the next couple of years. And that's why a bond ladder's flexibility makes sense.
Yeah, and I think that's a good point, Scott, because I think our take on that would be, we're not going to be on zero rates forever. The Fed may try to keep it that way as long as possible. But when I'm doing out projections for clients, and I'm projecting out 30 years down the future with their money, I'm not projecting 0% interest rates for the next 30 years. I'm going to build in probably 4%. At some point in time, we are going to see rates go higher. And yeah, laddered maturities do offer that sort of low risk way to keep investing at whatever the prevailing rate happens to be at the time. So sometimes you do got to hold your nose, and invest in those things, because it doesn't seem like the yields are very high. But we got to think of the safety purposes, but also, we mentioned a little bit about financial plans. For all clients, and we do build financial plans for our clients. You got to have a financial plan. Investing money is investing money. I had this discussion with a new client last week, actually, because they were asking about how we do things. It's really got to start with a financial plan. Oftentimes, where are you trying to go with all this? What do you need at retirement? We can help people decide that. and what kind of income needs you think you're going to need when you're whatever that retirement may mean. So for some people, it's 62 years old, 65, 70, 60, whatever the age is. At what point in time, what do you think you need for money? And then you sort of back in an investment allocation based on that. If you need to make 5% from now and for the next 20 years in order to have enough money at retirement, okay, that's one thing to try and build a portfolio that way. If you need 12%, okay, that's another thing. Got to take more risk. So, factoring in all sources of income, but you got to build that plan that's really a sleep at night kind of plan. All right. Anything else, Paul? Got anything else you want to cover here? We covered a lot of material.
No, I think that's a pretty good overview. I think we
Okay.
hit this.
Yeah. Yeah, I think so. I'm glad we hit Bitcoin. I had Bitcoin mentioned earlier in the conversation, but there was a lot of Bitcoin questions that we had. Again, it was a few weeks ago, but we had a lot of people ask about Bitcoin. So, all right. Well, great. Well, thanks everybody for listening again, and we will do this again soon.
Yep. Thank you.